Portfolio Builder members, happy Halloween. Today we have a lot of exciting news, and our portfolio has a record profit day over day. $10,150 in profits half an hour ago. It's probably up considerably more because the TLT is going up and the SPY is starting to sell off a little bit based on some impeachment fears and hiccups in the trade deal. Today's the day we trade the TLT every Thursday, and it represents 40% of our total assets. From this previous Thursday through today, the TLT traded from 140.10 to 141.37 for a profit of $1.27 a share. We paid an 8-cent debit to protect that position with an option caller and had to pay another 11 cents to close that out this morning for a loss of 21 cents on the option caller. The net return on the TLT was $1.06 on 3,700 shares. And when we look at the change in return on investment over the total portfolio, we went from a negative 0.4% return yesterday before the Fed announcement to a 0.3% return as of writing this update. And I would suspect after we close out our options on the SPY tomorrow, we'll be up considerably higher. So that's a profit of $10,150 in our portfolio, or a change of return of 0.7% in a day. Now we're trying to hit a 1% return per month on average, but if we have a flat or low month, that's not a big deal. Our bigger concern is not getting caught in stock market or bond market crashes and losing a lot of capital in a small amount of time. So we'll take a look at how well we've done with this. But the bottom line is we've delivered a profit in 10 of the past 11 months. And what's even more impressive is that during this same period, the S&P 500 has had a negative 15% return in December of 2018, over a negative 7% return in May, and a negative 7% return in August. Now, the S&P 500 did miraculously rebound from each of these events, but what if it had not? What if this is another 2008 moment? Would you just sit there and hang on to your buy and hold equities portfolio and watch it lose 40, 50%? When you consider the gains the S&P 500's had since 2008, there may be a much larger crash than just 40 or 50% this time. And in fact, if you listen to folks like Ray Dalio, he's actually expecting a much longer bear market, not just for stocks, but also for bonds that could last 5 to 10 years at a minimum. So we'll take a look at all of that in our webinar coming up in 2 hours. Hope you can make it live with us. We have a link. I'm going to go over a few outcomes of how I see these various bubbles popping. And the big picture is we're in a huge bubble in stocks and bonds. And what happens next could affect the outcome of which bubble pops first and how we can profit from that. So let's take a look at the current portfolio. You can see we have 37% in our model portfolio following the Monday, Wednesday, Friday SPY trade. It's delivered a 9.8% return in the last 11 months. Our Tuesday portfolio plays a smaller amount of our capital for good reason. It's much riskier. That portion of the portfolio has delivered a 13.9% return using 11% of our portfolio, and that's currently trading emerging markets. And then our buy and hold precious metals portfolio, which has been growing in size. This started off with a much smaller allocation back in December because the Fed was on autopilot rate hikes and quantitative tightening. And as he slowly did the Powell pivot, we've gradually gone from a 2.5% to a 5% to a total 10% allocation in this portfolio. And that's actually subdued the return we're reporting. So that shows a 53% return. If I had not been adding capital to that portfolio, it's actually up over 200% because of a huge run-up in Bitcoin and Ethereum. Now, we have not had a huge position in those assets, and I would never recommend that in our strategy. So 8% of that portfolio has been playing the gold market and 2% in the cryptocurrency market. Now they're very correlated and really serve the same purpose. But as we've added capital to that section of our portfolio, it still has had the highest return in the past 11 months with a 53% return. And that's after diluting it, again, by increasing the capital allocated to that section of our portfolio by from growing it from 2.5% in December to 5% in quarter one, and now up to 10%. Now, if things continue to head the way they might be with impeachment fears and a breakdown in the trade deal and the potential for massive quantitative easing, which is what the Fed said they would need to dramatically cut rates and ramp up the QE that they already have in place, we may even recommend going to a slightly larger position in precious metals. And to do so, we would do that by rotating into the Tuesday play, silver. So we'll take a look at some of those potential outcomes in our webinar coming up later today. And remember, just check your video, or rather your email, every Thursday at 1 Eastern for your access link. You'll get it every single week. It's a free webinar where we give out our market forecasts and teach a strategy for how we can deliver these consistent returns with very low drawdown. Here's our trade allocation currently: 100 shares of the SPY, 200 shares of emerging markets, 200 of TLT, and a buy and hold of 250 shares of the gold miner ETF GDX. That's per $75,000 in your portfolio, and this is actually 50% equities, 40% bonds, and 10% gold. So I will update that slide. If we look at the returns per month against S&P 500, it gives you a feel for what our goals are and how our strategy works. During that sharp sell-off in December, we walked away with a 1% return. Then the sudden rebound from the plunge protection team in January, 2.2% return. February, March, we had 1.7, 2.7. Going to April, pulled another 1.2. Surprise sell-off in May. That was over a 7% sell-off from top to bottom. And we pulled off a 2.2% return in June. The market flew higher. We didn't capture all that gain, of course, but we pulled in a 3.2. July, we were playing it safe. There was a meeting in Osaka between the president, and it looked like things were not going to walk away with the trade deal, but surprise, surprise, they said a trade deal was in the works and there would be agricultural purchases. So that didn't actually happen, but the market didn't get that news until August, so we did have a small loss of 1%. If the trade deal had broken down, we would have had a major stock crash and we would have delivered a nice profit as we were overly precautious and prepared for the bad news. Now in August, we were not prepared for the bad news. In fact, I was totally caught off guard, but because of our TLT position and the put option on the SPY, it reduced the losses on the SPY and delivered a large profit on the TLT during that sell-off in August when the trade deal did break down. And so then once again in October, we were playing it safe once again. And surprise, they said there is a trade deal once again, phase one trade deal. And now they're talking about potentially signing it in several weeks. So we'll see if that really works out or not. Today we're up 0.3% in our portfolio, and maybe even a little bit larger once we close out those options. The options in our portfolio don't register in the P&L until after we close them out. So the SPY has some profitable options in to close out tomorrow. So that'll be booked in our November return and not in our October return. Here was the trade alert issued today, just to review. Buy to close your November 1st, 2019 143 TLT call and allow your November 3rd, 2019 137 TLT put to expire worthless. It's only worth a penny and no one wants to buy it, so you have to let it expire worthless. However, we do always have to close out our short positions, and in this case, it's a short call. We've moved the strikes up $1 and pushed the expiration a week out, so we are selling the 144 TLT call today and then buying the 138 TLT put. Here's a look at how to close out the previous trade, and here's a look at how to open the new trade. Very simple, very easy. These trades take about 30 seconds to place, and then you're done. We absolutely, under no circumstances, will touch these positions outside of the trading period. So this TLT won't be touched until next Thursday. This makes the program very passive and easy to follow. Let's take a look at our risk chart. A little bit more downside risk with a $331 per contract maximum risk and a potential profit of $269 per contract. So that breaks down to a maximum return of $269 per share to the upside and a maximum loss of $331 to the downside. If the TLT travels above 144, that's where our profits get cut off. And if the TLT were to trade below 138, that's where our losses get cut off because we're short the call at 144 and we're long the put at 138. Now, if you do want to become a little bit more versed in our strategy, in the macro, and the options, we do have a boot camp, so keep that in mind if you want to really accelerate your knowledge and education. Let's take a look at the top news, as there is some breaking news right before this alert came out. Donald Trump. People are very disappointed in Jay Powell and the Federal Reserve. The Fed has called it wrong from the beginning. Too fast, too slow. They even tightened in the beginning. Others are running circles around them and laughing all the way to the bank. Dollar and rates are hurting our manufacturers. We should have lower interest rates than Germany, Japan, and all others. Well, that's funny because they're at negative. We are now by far the biggest and strongest country, but the Fed puts us at a competitive disadvantage. China is not our problem. The Federal Reserve is. We will win anyway. And then a little later, the impeachment hoax is hurting our stock market. The do-nothing Democrats don't care. House passes resolution to formalize Trump impeachment procedures. I am speaking with reporters at the U.S. Capitol as the House prepares for the next stage of our inquiry into the president's betrayal of his oath, including public hearings, so the American people can see the facts for themselves. Matt Gaetz, this is not a crime by our president. This is a setup by the deep state. I'll provide a little more commentary on that stuff in a moment. SPY ETF of the past month, you can see, has been ratcheting it up to new all-time highs. Sold off a little today with some tweets from China saying they're skeptical of a long-term deal with President Trump, despite saying they probably will sign phase one. TLT, after giving us a little bit of a hiccup this month, has jumped up after the Fed cut rates yesterday. This is signaling that the bond market's not happy and wants further rate cuts. Here's a look at our one-year chart on the TLT just to see how nice of a rally we've had for the past 12 months. And this has delivered quite a bit of profits to our portfolio. If we get impeachment heating up, if we get the China trade deal to break down, if we get more and more bad economic data coming in, TLT has much further to go. And for my estimation, if the Fed slowly drops rates as slowly as possible, the longest this could run up for would be about 2 years. That would give him 3-month increments to drop by 25 basis points until we get to most likely the bottom of the barrel, a zero interest rate. Now, would they do that quicker if we started to have bad news pop up? Probably. But that just gives us an idea for how long the Fed can get away with easing monetary policy before this long bond, long stock strategy potentially would break down. In our Tuesday play, we're long emerging markets since the phase one deal was announced, and that has been generating consistent return. And GDX also has been a good winner for us. We rotated out of GLD earlier in the year once the spot price hit 1,500. With prices that high, we'd rather own the mining companies who are just now starting to get these mines in operation and start generating some profits. In terms of predicting a long-term bear market in equities, I'd like to see either the LQD ETF crash. This is your investment-grade bond fund, which gives corporations cheap credit to issue bonds and then buy back their own stocks. until this path circle jerk between the bond market and the stock market collapses, it's going to be very hard to have a long-term sell-off in equities. Now, the junk bond ETF is not in as good shape, so we're also watching that. But really, the leaders of the SPY are the ones that need to crack before I'd be too concerned about our SPY ETF having a long-term pullback. So we might look at HYG as a leading indicator for the health of the higher grade bond market. And it's on the verge of breaking into new highs as well, following the path of the Fed. So at this point, a long-term stock market crash looks not very probable, no matter what headlines we get in the markets at this point in time. Should just be short-term volatility. The most important currency to track right now is the dollar against the yuan, and the path of the Chinese has been every time we make a tariff threat, they devalue their currency. Now in our boot camp, we plan to short the currency at the right time. This phase one trade deal may make a promise to peg their exchange rate at a certain rate and allow the U.S. to apply tariffs as punishment when the Chinese break their agreement. Now, do the Chinese really intend to follow any agreement, or are they just going to sign a deal and break the terms like they've done for the last several decades with every single deal they've pretty much signed, from the WTO to promises to the U.S.? The list is numerous. Here's our 30-year bond, which we use to predict the TLT. You remember, if this rate is going lower, that means the TLT is going higher. And you can see that sell-off in the German bond. This is based on some very bad news in Germany, which is our proxy into China. Now, we can't trust Chinese data because it's a communist state secret, so we don't know what's really going on. It's very opaque. But the German data is not in such a manner and is a much better judgment of the health of China. And clearly, China is slowing down. Now, the big question is, will China allow their country to go into a recession to try to put the U.S. in a recession ahead of the following election in November of 2020? They just might. So it's getting very interesting to see what the Chinese move will be. Now, with this impeachment pressure, they may very well want to just drag their feet on this deal and try to make Trump look bad and try to hopefully get their buddy Joe Biden in office, who's still polling decently, despite having quite a pullback in his polling. He's still doing better than all the other Democrats. And now there's rumors Hillary might come back. Now, I'm not sure if Hillary is very friendly to the Chinese, but we do know Joe Biden certainly is. Here's our 30-year Treasury, as you can see, following the path of the German. And the big question is, will we really pause on rate hikes like Powell says? Or are we headed towards a global slowdown and these rates are going far lower? So considering right now the rates are at a range of 1.5 to 1.7, the 30 years tracking just about 70 basis points above that. So if we were to cut the federal fund rate down to 0 over the next up to 2 years, then this yield could go far lower and the TLT could go far higher. So we want to remain long the TLT until the Fed doesn't have any more ammunition to manipulate this market. Meanwhile, gold popped back above 1,500 as the dollar's weakened slightly, and the Fed is continuing to put $60 billion a month into the Treasury market and having this rolling loan of about $250 billion in the repo market. So they're saying it's not QE, but it's just the same thing. Meanwhile, oil sitting still at the $60 range, which we're happy with. If it went below 50 or above 70, would signal two different concerns. Below 50, we get concerned about stocks. Above 70, we initially get worried about bonds because of inflation. Here's the dollar selling off slightly, but still very strong relative to other currencies around the world, showing the global slowdown is not picking up considerably yet. And meanwhile, our cryptos that we like, we have Bitcoin and Ethereum as our two crypto positions. 1% in Bitcoin, 1% in Ethereum, and that replaces 2% of our assets in gold. That's totally optional. And again, I see gold and cryptocurrencies playing a very similar role in our portfolio. Just gives us a little extra diversification. China is said to doubt long-term trade deal possible with Trump. Donald Trump. China and the U.S. are working on selecting a new site for signing phase 1 of trade agreement. About 60% of the total deal after the APEC in Chile was canceled due to an unrelated circumstance. The new location will be announced soon. President Xi and President Trump will do signing. Trump joins Kudlow to rescue market after China spoiled the party. We can see the China headline sent futures selling off. And then we got Kudlow and Trump saying everything's dandy. Northman Trader, technically gorgeous. They sure know how to time their headlines well. And you can see the headline sent the stock market back up. Now the impeachment again is causing a little sell-off in stocks. Fed's Powell, today's rate cuts were insurance versus ongoing risks. Outlook remains favorable. FOMC believes Monpole is in a good place. Economy expected to expand at a moderate rate. Job market remains strong. Apple surges after smashing expectations, beating on iPhone sales and projecting stellar holiday quarter. Now keep in mind, the way Apple's generating such huge sales is by giving massive financing plans for people to pick up these phones, and mainly through these different telephone companies. So the second this credit stops being so cheap, all of these numbers are not going to look so pretty. Facebook shares jump after top and bottom line beat. The long view. Powell is trying to signal he's staying put. Rates are at an accommodative level. Current stance of policy likely to remain appropriate. Powell, significant inflation rise needed before any rate hike. And since we measure inflation incorrectly, this will never happen. Daniel DiMartino. Right now, the Fed is conducting effectively QE, growing its balance sheet by $60 billion per month in Treasury bills. It does not have a lot in further interest rate cuts. I would remind you, we are coming into an election year. China's auto sales is likely to drop 20 million units this year, down 8% from 2018. We're also seeing a car slowdown in the U.S. Chicago PMI plunges to the worst drop in 39 years. Our country must act. Germany exports to shrink for the first time since the 2008 financial crisis. So here's why you got your bond market rally this morning. China's factory PMI probably held in contractionary territory this month amid weakness in external demand and business confidence. Bloomberg Economics expect the reading to undershoot the consensus, just showing China is continuing to slow down, and we're yet to see them inject a lot of liquidity or capital into their markets. So the question is why? Are they deliberately allowing their economy to slow? Secretary Pompeo, we accommodated China's rise in the hope that they would become more free. In response, the CCP took advantage of our goodwill. Now, the real Donald Trump is facing the reality of CCP hostility to the U.S. and our values. We must engage China as it is, not as we wish it to be. China Foreign Ministry asked about U.S. Pompeo's comments on China. Communist Party says Pompeo's remarks were a vicious attack against Chinese people and the party. U.S. Pompeo's remarks smear China's domestic policy and further reveals fear and arrogance. And now we begin the public trials. For boot camp members, I'll be sending you a Ukraine impeachment special daily dump that has about 8 hours of content with everything you ever wanted to know related to the Ukraine scandal. And the summary, though, is that the Democrats are going to focus on a very short time period with this trial and try to control the narrative. But if you look at the big picture, and it spans back way before 2016, there's a lot more to the story. And so too much for a daily dump, or rather a daily update video. But if you're a boot camp member, look for our daily dump. I'm going to give you more than you ever wanted to know about this. From Trump, now is the time for Republicans to stand together and defend the leader of their party against these smears. It would be one thing if there were any indication of an underlying crime, but there is not in the transcripts and not in the secret witness testimony that, and again, the new testimony is that parts of the transcript were dropped. Bolton to give closed-door impeachment testimony next week. Now remember, Bolton was fired, and then someone he had hired is now one of the testimonies. If any Republican votes for this impeachment resolution, they have abandoned this president, and they've done a terrible thing to the Congress by allowing this illegitimate investigation to be cloaked in a fox of legitimacy. House Democrats' impeachment resolution would just codify their unfair process. Here's what it contemplates. No due process now, maybe some later, but only if they feel like it. And that's a wrap for our daily content. A little quick clip about what we do and a reminder for the webinar coming up in an hour and a half. Let's just see who we have live here. We've got Tom, Ron, welcome. Thanks for joining us live, guys. We got 13 others watching live. Welcome, everybody. Daily income trade alerts at noon Eastern. Here's a look at our returns. We're not trying to outperform any market or any other advisory. Our goal and promise to you is to try to protect your capital and target a 1% return per month with very little risk of a significant sell-off or drawdown. As you can see, our only losing month was in July, and that was protecting against a trade deal breaking down, which did not break down. It broke down in August, caught us off guard. We still returned 1.8%. September, the S&P 500 was flat, going up and then down. And in October, we're now sitting on a 0.3% return. Hey there, Oscar. Yep. So we caught our profit in the last 24 hours of the month. Now remember, October started off really strong. We had a 1.1% return to start off October, thanks to the TLT and the sell-off in the SPY. And now once again, we captured some profits this month from the SPY and then got the nice pickup overnight from the TLT. So we did walk away with a nice profit this month, and I think we'll be doing well. Here's the breakdown of how to allocate your capital. If you want a little bit easier portfolio with less capital to start, you could try this out. Same risk profile, 50% equities, 40% bonds, 10% gold, 400 shares of EEM, and 100 shares of TLT. And this lets you follow the program Tuesday, Thursday, skip the SPY. Our simple 4 ETF portfolio is extremely diversified and all you'll need for retirement, income and safety, not growth or speculation. Simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. Attention non-members, offer of the week, a 40% discount, and that's off our normal $5,000 a year price tag for our complete advisory. Call Dean at 505-322-7515. This deal ends today, so call him right now and you can save 40% a year again. And if you're a member but have not upgraded to the lifetime deal, this will save you a heck of a lot of money in the long run. Plus, if you do upgrade to a lifetime deal, we're going to give you 4 weeks free in our boot camp. Boot camp starting up very soon. So call Dean at 505-322-7515 to get that special deal. Reminder, we have our paid webinar, which was yesterday at 2 Eastern. And then our free webinar is today at 2 Eastern. So check your email 1 hour before for the access link. Oscar says, in the green, awesome batting average. Astros could have used you last night. Oh, no. So I take it they lost. Huh? I was listening to a live stream from Glenn Beck, and he was he's joking that he was the only one doing a live stream during the World Series. So I was getting some scores from that one. All right, guys, any questions in the chat box before we get ready to prepare for our webinar? And if you want to join in an hour, Oscar, I may have some content that's a little more unique if I have time to put it together. We may save it for the Wednesday webinar, but I want to look at some potential outcomes in terms of stock market going to crash first or the bond market? And if so, how do the dominoes fall? All right, guys, thank you so much. Really appreciate everyone who supports our company. We're really having a great time providing this service, and we've now grown from no track record last December, only using the trade alerts to sell our product, no hypey sales letters, no big promises. We're now up to over 150 members. Very proud of the group that we've accumulated. Love to have these live guys with us each day. Really appreciate getting to know everybody, and hope to see a lot of you on the webinar in about an hour and a half. So thanks. Thanks, Tom.